Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by technical strategist Todd Sohn to talk all things markets. Todd, how are you doing today?
Hey, Ross, nice to speak with you as always.
Yeah, great to talk to you as well. And we're talking kind of at the end of a little bit of a rally in the market. So despite all of the headwinds out there that are well known, the S&P 500 is up around 11% over the last few weeks. So I wondered what you're seeing there, if you're seeing any momentum, what you all are watching, and in the end, does it look sustainable to you?
That's a great question. I divide this into two portions here. Number one, on a momentum basis, we've flashed two great signals this week. The percentage of stocks trading to a 20-day high exceeded 50% early in the week. That is a historically bullish signal coming off of important lows. Your forward returns and hit rates do come in over the next 3, 6, and 12 months above average. So probabilistically speaking, we're dealing with history on our side there. And you also had over 90% of stocks trade above their own 20-day average. That's another ingredient needed to come out of important lows. And so the momentum picture here is very supportive. I would say in terms of overall market trend, that's more neutral now, right? We're not dealing with the trends we saw back in late 2020 and 2021. So, the trend of the market leaves us a little uneasy, but when you get momentum signals like this, it is very, very difficult to fight. So we like that at our back, and we're curious to see how credit and leadership looks like going forward on any sort of pause here in the market. Does more risk-seeking groups start to outperform, and does credit remain stable? It's been largely supportive here, and as long as we don't see spreads widen out, we'll be in the positive momentum camp there going forward.
That's great context. And speaking of leadership, one of the things that we love to talk to you all about and your team specifically is, what sectors and what industries are leading versus which ones are faltering. Could you talk a bit about what looks like leadership right now, and also, what is lagging and why that, might make you nervous or why you might want to avoid it?
Yeah, what's curious about the expansion and new highs we've seen, it's being led by utilities and REITs. That's the more defensive groups in the market as opposed to more risk-seeking, discretionary or materials and energy for now. So that leaves us a little uneasy. The constituency of the new high list is a little weary for us. And conversely, the groups that are making us very nervous right now are two important inputs into the economy. The banks, especially the larger banks, have started to soften here. And then the home building and home retail stocks have also started to deteriorate. That's likely due to the rapid increase really in rates and mortgage rates here in the US. So we don't love how defensive groups are leading this market right now as opposed to, say, what we're seeing from the banks and housing. That is what makes credit so important here, is that if those two important economic inputs are going to deteriorate, I would guess you're going to start to see it show up in the credit markets. Not yet, but that keeps us on our toes going forward at a minimum.
Yeah, absolutely. And both worth watching, especially closely as rates rise, the yield curve flattens, all kind of wrapped up in this macro narrative and the Fed trying to get more aggressive as we move into the bulk of the year. Let's finish by shifting abroad. So one macro headwind is the Fed raising interest rates, trying to combat inflation. Another, obviously well-known one is war in Ukraine. How is that, through your all's work, impacting things like developed international, things like emerging markets? Are there any pockets you like in there? What are you watching on the international front?
So within emerging markets specifically, I think investors need to realize that Chinese stocks, which have had a meaningful decline over the last year and a half, about at least being cut in half, and then 70 to 80% in some individual cases, that's about 30% of the emerging markets index, where a lot of passive money goes. And so we're of this opinion that emerging markets really need to be unpacked and redesigned given the influence of Chinese stocks, and that seems to only be aggravated by what's going on with the Ukraine and Russia. And so if you want to play EM a little bit more actively, take a look at LATAM, Brazil, Mexico. Those have been very strong markets here recently. Mexico is one of the few places we can find they're actually at new highs. And I would guess it's because of their exposure to more material and energy type spaces, which have been great so far this year, as opposed to, say, the tech-heavy China and Korea shares that have taken a bit of a hit. Those are oversold, but we'd rather stick to the more LATAM space. And so just keep that in mind. China's influence on EM is significant and has been a meaningful headwind. If you look at Chinese funds, excluding EM funds, excluding China, they've outperformed by a large gap here, and I think are worth advisors look going forward. We have a good list of those. For those who are interested, please reach out, and we're always happy to help with some ideas there too.
Yeah, well, we appreciate that, and so I think if I could sum it up, the message is there's reasons for optimism. There's some momentum behind the broad market, but being selective in this kind of challenging environment, whether it's in sector and industry positioning or abroad, is going to be important. So that's why we have you on the team. We appreciate the time today, and hopefully we'll talk to you soon again.
Great. Thanks a lot, Ross.